Hello and welcome to another video on how to secure yourself financially. So, a quick recap of this beginner guide to financial statement is that, well, they show you the money, and there are four types of financial statements: the balance sheet that show what a company owns and what it owns at a fixed point in time; the income statement, how much money a company spent and made over a period of time as well; cash flow, the exchange of money between the company and the outside world, as well as the shareholders, the the statement of the shareholders, which shows the change in interest over a period of time. So the TLDR balance sheet is a snapshot of the company assets, liabilities, and equity, shareholders' equity over a period of time, whether it's quarterly, annually. Income statements show you how much money a company made, also known as the net earning or net losses. And the cash flow report the company's inflow and outflow of cash. So while the income statement can tell you whether a company made a profit, the cash flow statement can tell you whether a company generate cash, and it will use the information from the balance sheet and the income statement. And the bottom line of this shows the net increase or decrease in cash. So this is generally made of three parts, where each part review the cash flow from one of these activities: operating, financing, and investing. So in operating activities, it analyzes the net income and it adjusts for the cash or the total cash that was used or perceived from operating assets. So the way to do that is, well, it adjusts the net income for any non-cash items, so items that affect the income statements, but there is no cash transactions such as stock-based compensation, amortization, and depreciation, and it adjusts the or it adjusts any cash that was used or perceived from other operating assets and liabilities. And to get a clear idea of what are the most common operating assets and liabilities, then I look at, well, what are the most common operating assets, such as accounts receivable, inventory, prepay expense, so expense that a company made in advance to enjoy for certain good and service, such as premium insurance, whether it's health for medical coverage, home or vehicle to protect your assets in case of accidents or potential damage, your life in the event of the policyholder's death, liabilities such as lawsuits, disability, and long-term care such as home health care or nurse home care, right? Rent, marketing, office supplies, software license, and maintenance contracts are another example of prepay expense, right? Other example of operating assets are intangible assets, such as patents, which provide exclusive right to creators or inventors to make, manufacturers, and sell and distribute their inventions over a period of time. So, for example, maglev, this electromagnetic uh, device or this electromagnetic suspensions and stabilization system for ground vehicle issued in 1916, GPS navigation system using satellites in passing ranging technique issued in 1974, electronic device as their patent name uh, mentioned, or as we know, the iPhone in 2007, crisp gene editing in 2014. This is just a couple examples. Trademark words, designs, symbols that uniquely identify this company for the competition. For example, the Michael Burry famous quote, "Let's get ready to rumble." Copyrights, exclusive right to original or creator of original works to protect your assets and give exclusive right to sell and distribute that over a period of time, such as McDonald's, Netflix, Spotify, Twitter. Trade secrets, which are confidential data that a company uh, might use to gain competitive advantage, such as formula, process, or customer list, customer relationship, and goodwill. This is the brand reputations. Yeah, the brand reputation, uh, recognitions, and customer loyalty. And another operating asset, and it's very interesting, is investment in affiliate. So here is when you or when you have a company that invests in other companies to earn influence but not full control. And the whole point of this is earn a profit or a return from the investment or on end gain some competitive advantage. So such as joint venture, which is a partnership between one or two companies to undertake a specific business, or a project where each part receives a share of the joint venture, such as Post Malone and Crocs. Equity investment is when a company purchases significant amount of stake in another company's stocks to gain influence and potentially write its voice on the other company's management decision, such as Berkshire Hathaway, this multinational holding company that invests in a variety of industries such as energy, real estate, and retail. You have SoftBank, which is another, but this in this case, this is Japanese conglomerate holding company that invests again in a variety of business, but specifically on technology, like how do you say? Like Airbnb, Uber, WeWork, Alphabet, which is the parent Google company that invests in most of the technology company, such as Calico for health and longevity, and it does that through its venture capital arm. Also, we have is TGP, Texas Pacific Group, which is a global private equity that invests in a variety of sectors, whether it's retail, health, uh, and a most notable investment is Airbnb, as well as Blackstone, where this is a global firm that invests in another variety of company like energy, real estate, and all of them we invest in most of the time in real estate. So them, okay. I also look at another investment in affiliates like or this partnership, limited partnership when a company invest on a limited partnership to provide and they provide a share of ownership and control over the limited partnership assets and operations. So most of the time these limited partnership are or these investment vehicles are used as for private equity or investment, private equity or real estate. Okay, cool. Now then I look at um, as associates, right? So where it's investors that owns a significant amount of share in another company, typically around 20 to 50% of the share. And also I look at another operating assets like a cash and cash equivalents, like money markets, funds, which the whole purpose of that is to invest in a very short-term debt, financial instruments, and they're not suitable to for long-term investment, such as you have bank notes or bank deposit, which is savings that a bank or savings certificate that a bank issued with short-term maturity, as well as uh, bank bank debt issued by banks, corporate debt, which is a very risky uh, financial instrument, and government debt, this repurchase, repo, money market, repo in money markets. Mhm. Repurchase agreements. Repurchase agreements. So after I look at the most common operating asset and understand that, and I'll be able to mention that, okay? Again, quick recap of the operating assets. We have inventory, accounts receivable, property, plants and equipment, prepay expense, investment in affiliates, and intangible assets, cash and cash equivalents, goodwill, all right? And when it comes to look at the operating liabilities, so I find out we have is accounts payable, okay, which is a certain amount of money that a company uh, owns to other company for service that has been enjoyed. Mhm. So, for example, we have is in operating liabilities. We have is account payables, accrued expense, uh, and this in Spanish is gastos acumulados. So accounts payable, something that I already mentioned. Okay. Example uh, of that of account payable, right? Is raw material, office supplies, and service. So they are accounts payable, or in Spanish, cuentas por cobrar. But again, it refers the amount of money that a company owns to either suppliers or vendors for goods and service that have been received but not yet paid. For goods or service that you have enjoyed but haven't yet paid. But not yet paid. Okay, so that's accounts payable. Usually, this is short-term liabilities, such as 30 or 60 days. An example of account payables are raw materials, office supplies, and service. Okay, again, remember the definition. The account payable is money that a company owns to its vendors or suppliers for service, for good and service that has been received but not yet paid. But not yet paid for. Exactly. So usually these are short-term liabilities in the period of 30 to 60 minutes, 30 to 60 days. And examples are, well, raw materials, office supplies, and service. Okay, each one of them are a good or service that a company receives from its vendors or suppliers that has been received the but not yet paid for. Okay, so for example, raw materials, office supplies, and service. So there are good and service that have been received but not yet paid for. You know, but not yet paid for. Okay. So okay, this is example of accounts payable. In Spanish is cuentas por pagar. So accounts payable, in other words, is money that a company owns to its suppliers and vendors for goods and services that have been received but not yet paid for. And usually this is a short-term liabilities, 30 to 60 days. And most common examples is raw materials, office supplies, and service. Okay, good or service that a company owns to the suppliers and vendors. And the subtle difference between here, make a quick quote, quick tangent, is suppliers are companies or people that where they sell you things that you need, whereas vendors, there are people that sell things you might need or not. So that's a subtle difference between vendors and suppliers. Supplier is something that you need for your company's operations, whereas a vendor might not, or not necessary. Okay, so that's accounts payable. In operating liabilities. Then I look at accrued expense. In Spanish, this is gastos acumulados, which okay, gastos acumulados or accrued expense, money that a company owns, accrued expense, money that a company owns to others. Yeah, money that a company owns to others for service that has been received from. Accrued expense. Okay? Or accrued expense, expense that a company has incurred but has not yet paid for, or recording it as account. So the subtle difference between accounts payable and accrued expense is that accounts payable is money that a company owns with its suppliers and vendors. Okay, exactly. So accounts payable is money that a company owns with its suppliers and vendors for service that have been received but but has not been but has not for service that has been received but not yet paid for. Exactly. For service that has been received but not yet paid for. Whereas accrue expense are expense that a company incur, okay? Expense that a company incur but has not, yeah, a company that expense that a company has incurred but has not yet paid for or record. And these expenses are recognized in the company financial statement as a liability, as they represent an obligation to pay for a good and service that has been received and for which payment has not been yet made. Okay, so in contrast with accounts payable, the accrued expense again are uh, expense that a company expense that a company has incurred but has not yet paid for or recording it as account, meaning it's an obligation that a company has to provide or to pay for good or service that has been received. Exactly. It's an obligation. Okay, it's an obligation for it's an obligation to pay good and service that has been received, but for which payment has not been yet made. Okay. Yeah, as they represent an obligation to pay for a good or service. So, in other words, unlike accounts payable, which are money that a company owns with its suppliers and vendors for service that has been received but not yet paid for, okay, but not yet paid for. An example of that is raw materials, office supplies, or and service, and these usually are short-term liabilities, 30 to 60 days. Accrue expense are expense that a company incur but has not yet paid for. In other words, represents obligations, not necessarily to its vendor or suppliers, but it represents obligations to pay. It's more general. It's more general. Okay. But it represents obligations to pay good and service that has been received but not yet paid for. Okay. So for example of this, all right, is salaries, rent, utility, and taxes. Again, this is expense that are not, or this is money or expense that are not linked directly to the suppliers and yeah, that are not linked to the suppliers and vendors. Okay. Again, obligations that a company expect to pay for good or service that have been received but not yet paid for. For example, salaries and wage. Exactly. So salaries and wage, rent, utility, and taxes. So now things are starting to make much more sense on this. Okay. When you see the difference. And then I look at deferred revenue. Okay, meaning this is um, deferred revenue, meaning this is payment. Okay, because after all, deferred revenue is payments that are, let's go to read about that. Deferred revenue refers to payments received by a company in advance for good or service that has not yet been delivered or provided. In other words, it represents revenue that has been collected but has not yet been earned. Deferred revenue is recognized as a liability on the company balance sheet until the goods and services are delivered or provided. So here is you collect the payment but you haven't provided the good and service. Okay. Whereas with accrued expense are expense or there are obligations that a company has to pay for good and service that has been received but not yet paid for. So you haven't paid for that, but you receive that. Uh, this is from accrued expense, and accounts payable is somewhat is the same for accrued expense, but now oriented to vendors and suppliers. Okay, so you see the relationship here. Cool, totally cool, great. Now in deferred revenue is payment. Okay, so payment that you made, no payment that you have collect for good and service that you haven't provide. Mhm. Okay, okay. So payment that you have collect for service that you haven't provide. So for example, subscription service like Netflix, Spotify. So they collect the money first, and then they guarantee the service, right? Prepay maintenance service. Mhm. Prepay maintenance service and gift cards. Prepay maintenance service is a company provide maintenance service for its product and receive payment for several months or year in advance. The portion of the payment that relates to future period will be considered deferred revenue. Because after all, you have this obligation to, even though that you collect the payment to provide the service, the good and service. Okay. Okay, so the TLDR of this is accounts payable refers to the money owed to the suppliers and vendors for good and service that you have received but not yet paid for. This is usually short-term liabilities, 30 to 60 days. And examples are raw materials, office supplies, and service. Accrued expense, on the other hand, are expense or obligations that a company expects to pay for good and service that have been received but not yet paid for. This is more general, such as salaries and wage, rent, utility, and taxes. And deferred revenue is payment that a company have collect, but uh, yeah, payments that a company have collect. Mhm. So payments that a company have collect in the hope, or in the payment that a company have collect to provide, so payment that a company have collect in advance for goods or service that have not been delivered, for good or service that have not yet been delivered. Okay, in other words, so deferred revenue are payments that I collect as a company, payment that I collect for good and service I will provide you in the future, in the near future. Okay, an example is subscription service, prepay maintenance service, and gift cards. Okay, but for that you must have someone to provide value. You know what I mean? For that you must have someone to provide value. Okay, okay, okay. Cool, cool. And so that'll be all for this video. Take care. Bye bye.